Hi friends, congratulations on completing level 1 of account executive module. Now let's move on to level 2, which is reporting. In this module, we will majorly see what kind of reports accountants prepare for their managers to help them in decision making and how they prepare these reports. Let's begin with first type of report, which is bank reconciliation statement. We all have learned about this statement in 11th standard. I will just quickly revise it with a simple example. Now let's say you have deposited a check of rupees 20,000 in bank. So your bank balance should increase by 20,000. But after 2 days when you check the balance, it's just 16,000, short by 4,000. So what you will do, you will immediately get the bank statement and see why there was a difference. There might be multiple reasons for it. For example, there can be an automatic payment or bank charges deducted. That's why there is a short of 4,000 rupees. Similarly, in reality, there could be multiple reasons why there is a difference between the balance as per your ledger and balance as per the bank statement. The bank statement is prepared by bank, and whereas the balance arrived in your ledger is because of the entries posted by you as an accountant. So reconciliation is very important. Let's look at some of the popular scenarios which comes into reconciliation. Scenario 1. Suppose the balance as per your ledger and the balance as per bank statement is 10,000, and now you issue a check of rupees 4,000. So you will reduce the balance and you will show the balance as rupees 6,000. But the person to whom you have issued the check has not visited the bank and has not deposited the check. That's why the bank balance remains at 10,000. So while preparing the reconciliation, what you will do is you will add back stating a reason that a check issued but not presented for payment. Now let's look at scenario 2. Again, let's assume that balance as per your ledger is 10,000 and balance as per bank statement is 10,000. Now you have received a check from your client, which is a payment check of rupees 5,000, and because of this you increase the amount of your books from 10,000 to 15,000 by adding this 5,000 check. You take this check and deposit it to bank, but the bank balance will still remain 10,000 because it takes 1 or 2 days to clear that check and to reflect the balance as 15,000. So in between, if you are preparing a bank reconciliation statement, you have to reduce an item, you have to reduce your bank balance with 5,000 and give the description check deposited but not cleared. Now let's look at scenario 3. Suppose bank has deducted charges of 2,000 from your balance, which was originally 10,000. So the balance as per bank statement is 8,000. 10,000 minus 2,000, 8,000. But the balance as per your books is 10,000. So when you check the bank statement, you will see that there are charges, and now it will not be a reconciliation item. What you will do, you will record a transaction of this expense of 2,000, and then your balance will get reduced from 10,000 to 8,000, and this is how you will reconcile in this case. Now let's look at the next scenario, which is scenario 4. Suppose bank has done certain mistakes in recording bank statement. So while reconciling, you need to approach bank and request them to rectify the statement. And suppose if you have made the mistake, then you have to pass the reversal entry or pass an rectifying entry. This is how there will be multiple reasons for which there are differences, and this is how this statement of bank reconciliation looks like. Friends, nowadays most of the bank reconciliation statements are automated. You have to just give clearing dates and pass the missing entries, and automatically the bank reconciliation statements will be prepared. But you have to check each and every item. So that is your role. Now let's move on to the next statement, which is cash flow projection statement. Now let's understand what is cash flow projection statement with an example. Suppose you are a college student and every month you receive a pocket money from your parents for incurring your recurring daily expenses. But how this amount of pocket money is decided? You take all your expenses like traveling expenses, canteen, food, etc., and subtract whatever minor income that you have. Maybe let's assume as a scholarship. So you will add all your expenses and subtract all your incomes, and that's how the final amount of your pocket money is decided. If you record this on a piece of paper, you will get cash inflows on one side and cash outflows on another side, and the balance is what you will need extra cash. So this is known as cash flow projection statement. You project what will be future cash inflows and future cash outflows to determine how much surplus you have or how much cash you will need. And similar to this, businesses also wants to know how much cash they require to run their day-to-day operations or to purchase assets, and how much cash inflow will be there from the income or from the sales that they will make. So as an accountant, you have to make a list of all the cash inflows and all the cash outflows and submit it to your manager, who will then make the necessary arrangements. And this is how a cash flow projection statement look like in reality for your practical exposure. You can see cash inflows and also some cash outflows and the balance below. Now let's look at the next type of report, which is budget. A company includes multiple departments, right, which incurs many expenses like rent, advertising, salaries, etc. So there are like hundreds of expenses which a company incur, but a company has limited funds. So each department, how much they should spend is allotted to them at the start of the period, which is known as budget. For example, a rent is budgeted at 10,000. A company should not spend more than 10,000 rupees in a month, and this 10,000 is known as budget. So as an accountant, every month you discuss with multiple teams and arrive at a budgeted amount, and these teams, for example an advertising team or an advertising department, are not expected to spend beyond this cap. Now let's look at the next report, which is linked to this report, which is variance report. What happens, suppose you have allotted 10,000 rupees to an advertising department, but they have spent extra 11,000. For example, they have spent 21,000 instead of 10,000. So this extra 11,000 is known as variance, the difference between what is the budgeted cost versus the actual cost, the budgeted expenditure and the actual expenditure. And this difference, as I said, is known as variance, and the advertisement department has to give a reason at the month end why they have spent extra 11,000 rupees. Similarly, each and every department who are spending more or spending less have to give the reasoning why they have spent more or spent less, because everything has to go as per the plan. And this is how companies are run, and this is how a budget statement looks like, and this is how a variance statement looks like. Currently there are also available certain software which have this pre-built format wherein you can input the expense and also the amount of the budget and the variance, so that everyone can work in collaboration. The next report that we will learn about is FD interest accrual report. Your company might have certain FD, and we already know what is the accrual concept. You have to accrue income or accrue expense at the month end. So all these FDs which are there with the banks might have accrued certain interest, and you have to calculate them. How you will calculate them? So first take the FD amount, see what is interest is there on that particular FD, and multiply by the period that is already done divided by 365. This will give you the interest accrual amount on that particular FD. Similarly, you have to follow these steps or calculation for all the FDs and accrue the final amount, which is FD interest accrual amount in your books. And this statement is known as FD interest accrual statement. Now let's move on to the next statement, which is TDS default reporting statement. Friends, we already know what is TDS. We have already learned it in level 1. Suppose if your company offers certain services and the payment amount exceeds a certain limit, then your client who is required to pay you will make you a payment, but after deducting a part of that particular payment. Suppose if you are required to receive 1 lakh rupees, then your client will deduct 10,000 and pay you 90,000, and this remaining 10,000 he will deposit with government, stating that it's a TDS which they have deducted on our behalf. But what if your client has not actually deposited this amount with the government? So you have to get this statement from the government, which is known as 26AS report. This you can download from income tax portal. In that statement you will get the list of all the customers who have deposited the TDS on your behalf. So you will take this report, which is known as 26AS report, and you will compare it with your records. And suppose if you don't find any particular individual who has not deposited the amount, You will call that client and follow up for depositing the amount to the government, which then will reflect in form 26AS, which is also known as 26AS report. And how to download this report? Visit income tax site, go to home, my account, and there you will find form 26AS. Download this report, and this is how a 26AS report looks like, and start comparing it with your actual report, and whatever differences you arrive, show it to your manager or to the follow-up team. Or sometimes in some companies, accountants do follow with the client for making the TDS payment. So this brings us to the end of this module. You can find all the report formats in the download section for your reference, for your practice. So go through all the report formats and try to understand how they are prepared.